been trying to figure that out for a while. Come on, the camera's on. Hit the button. Hit the button.
Welcome to the asset allocation meeting, and we have to do a roll call. Just everyone announce for the record that you're present.
Okay, Rosemary DeBellis, designee for Police Commissioner Bratton.
Susanna Vickers, designee for Controller Scott Stringer.
Sean Adler, designee for Mayor Bill de Blasio.
Antonio Rodriguez, designee for Finance Commissioner Jock Jiha.
John Dorsa, alternate designee for Controller Scott M. Stringer.
Bob Ganley, designee for Ed Mullins, SBA, proxy for Lou Turco, LBA, Roy Richter, CEA, Mike Palladino, LBA. Well, DEA, I'm sorry.
Close enough.
Close enough. Joe Alejandro, PBA.
Dan Torelli, PBA.
Joe Rayo, PBA.
Miles Draycott, Controller's Office, here by invitation.
Mike Haddad, Controller's Office, here by invitation.
Scott Evans, Controller's Office, here by invitation.
Rob Appling, Wilshire Investment Consultant. Here, what's that? Oh, Andrew Junkin, Wilshire Investment Consultant.
Sherry Chan, City Actuary, present by invitation.
Kevin Holloran, Police Pension Fund, here by invitation.
Nicole Jambrisi, Police Pension Fund, present by invitation.
Bob Sansky, State Pension Fund, present by invitation. Christopher Brad, PBA, present by invitation.
Okay, thank you, everyone. And with that, I'll turn it over to Scott, and we do have a quorum.
Okay, thanks very much. We have Wilshire here to report back on the questions that were asked at our last asset allocation meeting. And I'll turn over to Rob to go through the deck.
All right, thanks very much, Scott, and I appreciate everyone making more time this afternoon. We'll be sure to be pithy with our comments and go through this relatively quickly, but at the same time, we want to make sure that we're getting all the questions answered and everyone feels comfortable with the direction that we're going. Just as a quick review, because the last time we talked about asset allocation was March 9th, and just as a little bit of background about the process here, when we first started working on this, really the goal was to see, to do a comparison and contrast the ability to hit a 7% return goal using, traditional asset classes or low-cost asset classes like equities and fixed income, versus using more alternative asset classes like hedge funds, private equity, private real assets that obviously have higher fees but might also provide some preferable risk-adjusted returns. Then we also wanted to, given the low return environment that we're currently operating in with still very low interest rates and equity valuation somewhere fair to elevated, is that even possible given the headwinds that the capital markets face? And then finally, we introduced some new ideas on low volatility equity, a way of generating equity-like returns with the potential for 20 to 30% less volatility or a smoother ride along the way. So those are the three key areas that we were talking about leading up to today, and then we'll go right into the analysis and answer the questions that were raised at the March 9th meeting. So with that, if everyone has got a copy of the materials, I'm going to turn right into, I'm going to go past slide 4. Slide 4 is our expected returns. If you've got any questions about that, we'd be happy to stop, but essentially, relatively muted returns for public equities around 6.5%. Obviously, with the interest rate environment still low, around 3% for core fixed income. But let's go to the heart of the presentation, which is really slide 5. What you're seeing on slide 5 is really the analysis. So on the far left side, you have all the asset classes going from U.S. equity to the top to all the way down to TIPS. And the way we think about asset classes is really what is the objective that they're designed to meet in a portfolio. And that's why you see 3 core buckets there. Growth assets, just like it sounds, designed to achieve long-term returns. Volatility hedging assets, a hedge against the volatility in equities, also a hedge against deflation with fixed income, and finally inflation protection assets, things like real estate and TIPS. And then as you go left to right, what you're seeing is your current target asset allocation and then some alternatives. You see them grouped into 2 categories. alternative 1 and 2, and then alternative 1 and 2A. And the difference between those is the introduction of low volatility equity with anything that has the letter A next to it. So, and then anything that you see with alternative 1 is your low cost portfolio. Just public equity, just fixed income. And then alternative 2 includes alternative assets, like I mentioned earlier, absolute return and private equity. Going back to the original idea of the exercise, and just to cut to the chase, the whole idea is it possible to achieve, a 7% return? If you kind of want to look at the very bottom of the page, you can see our expected returns. That's labeled as median return there, the fourth or fifth to the bottom line. And you see the expected return of your current portfolio is 6.47. The lower cost can achieve a similar type of return, 6.41. But then you see the increase in standard deviation, almost 200 basis points. So, by eliminating things like absolute return, private equity, real estate, we think, you can still get a similar type of return, but you're going to assume more risk along the way. And then alternative 2, the way we try to compare this is to say, what type of similar type of return can we get for keeping risk constant? So in blue, you can see that the 11.75% for standard deviation matches your current risk return profile of about 11.76%, so 1 basis point, but essentially the same risk, the same level of risk as where you're at today. That includes, a few changes at the margin. You could see an increase in private equity. You can also see an increase in some opportunistic fixed income investments like high yield and the opportunistic fixed income bucket itself. You also see a decrease in core fixed income. So alternative 2 could seem like you're reducing fixed income, but really when you consider opportunistic fixed income, core fixed income, and even at the very bottom there, TIPS goes up a little bit as well. The total amount in fixed income is about the same as where you're at today. You also see some other increases in absolute return going from 5 to 6.25, and then finally 6 to 7% if you combine core and opportunistic real estate together. So that's a quick summary. I'll stop here in a minute, I promise, for questions, but just want to get through these four portfolios you're seeing here. Then on the far right side is very similar types of portfolios as that you see with alternative 1 and alternative 2, but the addition of low volatility equity. In the alternative 1A, you can see a 5% allocation to U.S. low volatility, a 5% allocation to international low volatility. And then on the alternative 2A, you see 4 and 2% respectively in those two buckets. So the rest of the portfolios are very similar between alternative 1, alternative 2, and alternative 1A and alternative 2A, but those include low volatility equity. So the benefit of low volatility equity on the very bottom at the portfolio level is marginal, but we think you can also, and this might be another conversation for another day, but at the investment manager level, we also think you can add significant risk-adjusted returns as well. But you can see that with alternative 2A, for example, that risk level stays the same at 11.76, but now you get a little bit higher return with 6.74, or about 3 basis points higher than from where you're at today. So long story short, we think low volatility equity, even at a marginal amount at the portfolio level, can be an attractive area. And also just to kind of dovetail on some recent conversations we've kind of talked about with ways to reduce risk in a portfolio, we think low volatility equity can be a risk reducer from there. So sorry for the speed with that, but I kind of wanted to go through that relatively quickly. But let me stop there because this is really the heart of the analysis. I do want to answer the questions that came up on March 9th, but is there any comments or questions at this point on sort of the review of where we're at today? Okay, hearing none, let's keep moving along here. Slide 6, I'm not going to cover. It's just the constraints that we used to come up with the previous slide, so feel free to stop me if you've got questions about that. And then, as you might imagine, when we talked about keeping risk constant and increasing returns, if you want to turn with me to slide 7, we think alternative 2 and alternative 2A can move your efficient frontier curve up and to the left. You want to be in the top left hand corner of that chart, and we think the risk-adjusted benefits of alternative investments can help you do that. And then obviously the marginal increase with low volatility equity as well, going from 2 to 2A. I think slide 6 is important, or sorry, slide 8 is important because what this shows you, it really zooms in on the long end of the risk frontier. So one question I think that we had in the last meeting was none of these numbers are showing, 7%. So what is it going to take to get there? I think that's where you have to balance, the return objective with really using a prudent amount of risk. And what I mean by that is you have to assume a lot more risk on that far end of the efficient frontier curve to only get incremental changes in your expected return. Another way of saying that is we don't think it's a prudent path to try to go from 6 3/4 up to 7 because you're assuming a lot more risk because that curve is so flat along the way. Okay, so if we want to go into the updates from the questions, when we talked about this in March, the question was raised. Okay, so we have a couple options here. We have low cost, and then we have alternative assets included, but we included all of them. We included absolute return. We included real estate and private equity. What if we just took those apart one at a time? What if we just said, okay, what does a portfolio look like X hedge funds? What does a portfolio look like X private equity, X real estate? So that's what you're seeing on these particular charts on slide 11. And just like I outlined, if you look at alternative 2 and alternative 2A, versus alternative 3, you see a big red box for private equity. Alternative 4, you see a big red box for absolute return. And finally, alternative 5, you see 2 red boxes for the real estate. So kind of taking those out one at a time. And what you see is a gradual decrease in expected returns along that pathway with really a very similar amount of risk. And so what we're saying there is you're now moving, instead of moving up to the left on that efficient frontier, now you're moving the opposite way. And that's outlined in slide 13, where if you start with alternative 2, that's the gray efficient frontier, and then obviously move down to 3, 4, and 5. Obviously the most dramatic change with alternative 3 with no private equity. You don't have to flip around, but private equity was really the only asset class in our assumptions that actually had an expected return over 7%. So really using that as a return driver in the portfolio, you can see the decrease by taking that out of the portfolio. Okay, and then as you might expect, I'll just wrap up here and then open it up for questions. If you turn with me to the low volatility changes, a very similar pattern moving from alternative 2A down to alternative 4A, 5A, and 3A, and finally your policy target. So a lot of slides, a lot of efficient frontiers for me to say that we think the alternatives portfolio can increase your risk-adjusted returns, and we also think that low volatility equity makes sense within your public equity portfolio. Obviously, that's a new idea. I mean, more so on the low volatility side. So we're happy to do some, initial more education on those, have follow-up materials on those, but just kind of wanted to stop here for the sake of time and the sake of everybody's mental health, given the day today. But see what questions there are or feedback or comments on the analysis.
Just on 2, and you mean just on page 11, not through the rest of the presentation, not going to the ultimate, I guess, recommendation, correct? Or
yeah. So, so if, as you might, I'm kind of alluding to, is our recommended portfolio would be alternative 2A. We think it makes sense to increase exposure or add exposure to low volatility equity and maintain your exposure to alternative assets. Sorry.
So, and just to clarify where we are in the process, because we're trying to coordinate the process across, we would hope that you'd select one of these that had, you're selecting the asset classes that are in there. We would work with Wilshire to come back on exact allocations. They might be slightly different as we put, BAM's recommendation on top of Wilshire's on top of all the others. There's no reason you need to worry about all the others we do. But that's the process. You would just pick So if you pick 2A, you wouldn't be picking specific allocations. You'd ask us to come back with a asset allocation that included all of those asset classes in it. And that's consistent with what we've done at the other system.
So 'cause I guess my first question was going to be on the fact that none of these portfolios leave any kind of room for a denominator effect. And so that was kind of my thinking, that they're all at 25% exactly on the basket, but hearing that,
Yeah.
and that makes it a little bit different. My second question is on the low volatility equity, just kind of in general, and folks' thoughts on whether or not it ends up really kind of being an implementation decision versus a, because I imagine particularly in this asset class, you can, there's a ton of different ways to implement a low volatility strategy. We could, diversify away all the kind of the sector risk that might come with it and stuff like. So just wanting you all's takes on whether or not you feel that's more of a implementation decision or a kind of actually asset allocation decision.
Yeah, so of course, being a consultant, I'll say both, because we have clients that do it both ways. We have clients that say, we're going to have U.S. equity or non-U.S. equity or some sort of global equity portfolio, and we're going to let low volatility be an investment manager decision. What's presented here is it actually being an asset allocation decision. As you can see, the difference between alternative 2 and alternative 2A that has low volatility is really marginal, because you're talking about adding a 6% allocation to something that's not going to really move your total portfolio needle very much, but we think it will move the needle within your equity allocation.
And as it kind of just as a follow-up to that, because thinking about the next step about kind of coming back with once we pick an allocation, and assuming that we pick a allocation that includes it, then I feel like that ultimately that decision is almost it feels almost like a BAM decision in many ways, as far as like picking our active managers. And so I wanted to get a flip.
So one way you might skirt that for the moment is to say that that you'd want us to consider all the asset classes in 2A, but you're okay if low vol ends up being a subcomponent of the equity allocation, just like small cap is a subcomponent. And as you say, you have clients that do it both ways, and we could consider that and work with Wilshire on this. There's some timing decisions. I think we mentioned them at the last meeting, and if you consider it as a subcomponent of equities, it gives BAM and Wilshire a little bit more flexibility on the timing of putting an allocation in. The downside is that you really can't compare low vol to the equities, and so we need to be careful when we present to you that we're comparing it against the right standard, and so we'll have to think about how we might do that. But if you could, give us 2A with the proviso that you could either tuck low vol in or have it separate.
There's no decision on this today, right? We could review this for.
What we'd like to get to today, Joe, is a decision that you'd like to. I mean, if you want, I'm not anticipating this based on the conversations we've had before, but if you wanted to say, you know what, we don't want to pay high fees, we want only low-cost allocations, then alternatives 1 or 1A would be the thing for us to go away and do. If you didn't want hedge funds, as NYSERS decided they didn't want hedge funds, when we came away from NYSERS, they said, come back to us with specific allocations, but use the column that has no hedge funds in it. So we've given you, the various columns here. Both BAM and Wilshire prefer 2 and 2A, which give you all the asset classes. And it's been BAM's position consistently with you, with NYSERS, with everybody else. Once you made the decision, either low cost or a full cost option with all the alternatives, we think it makes the most sense to have all the alternatives rather, or none. And every consultant, including Wilshire, sees the same thing. If you're going to have alternatives, you're better off having all of them. As you can see from their analysis, you buy very little by taking one out.
So the vote is today, essentially choosing one of the options and then getting back to us further with more of the filling it in.
Right.
kind
Yeah,
of
choosing the choosing the assets in the option. We'll come back to you with the specific allocation recommendation.
So why don't we cut to the chase, because I think you guys have presented a good explanation of maintaining a lot of the asset classes that we have, and we spoke about it already. I'm good with making a recommendation that we look at alternative 2A and maintaining all the asset classes within that recommendation.
Would you also recommend, Joe, that we have the flexibility Antonio was talking about, that we could either tuck the low vol into equities or have it separately as we have in 2A?
I think we should have a further discussion on that.
Right. So
rather
we'll
than
leave
just
that
vote on
open.
that today
Yeah,
and leave that open.
yeah.
But I'm prepared to go with Wilshire's recommendation on all 2A. And then we could have that further discussion. Yes,
If I could just give my perspective on low vol as a separate asset class or not, and we do have clients that have done it both ways. If you look towards the back of our book, we compare our assumptions for low vol and traditional equities, and what you'll see is that they don't match up. The expected return is the same, and so what you end up with, if you implement low vol as part of a traditional equity portfolio, is you end up with tracking error with no expected excess return, and you'll never make that allocation, which is why we try to deal with it at the asset allocation level, because you're actually reducing total risk.
No, I saw that. You had that in there. It's
So-
not helping you on the return itself. It's just,
Right. So that's my bias, is just dealing with it explicitly. It may change the way you benchmark things, but we can work all that out. I just wanted to kind of get that out there for consideration.
Yeah, if we go with low vol, we'll find some way of avoiding that problem that I'm very familiar with other wearing other hats.
at the end of the day, I mean, if whatever ultimately if you want to have that discussion, I'd like to see some examples, real world, as to performance and compared to, either us or others out there, if we were to do this or not do it. Okay.
We've got year-by-year index returns for low vol versus non-low vol in the back in the appendix.
Right.
That's not at a total fund level, but we can put something together for that if you'd like
just
to
to
see
give us
that.
some context here.
So, I've got a couple of concerns about 2A. In fact, all these allocations call for 10% private equity. And, the current target is 7%. And it just seems to me that for us to get to 10%, probably take the entire period,
Yeah.
not longer.
So this is exactly why I'm suggesting we think about asset classes and not the allocations, because there's some practicalities that we haven't imposed yet. And so what'll happen after we do this with all 5 boards, which we're in the process of doing, we'll go out and we'll say, okay, how much can we really do? How many boards want to do private equity? What's realistic in the timetable we're talking about? And we could come back and say, we had the same discussion at another board that you're familiar with, John, about real estate. Could we get to the real estate allocation? We'll come back and be prepared at the next meeting.
What I just want to request is that we can take a look at thank you, I'm sorry. That we can take a look at, when you come back with specific allocations, what the return is, what the risk is, what the Sharpe ratio is, that we can actually achieve, that you believe that we can actually achieve, versus what we have in this theoretical allocation here. And, I'll just say that, at NICERS, I voted for an allocation that does not include hedge funds. And the truth is that on Wilshire's comparison here, there's essentially a 4 basis point difference between having hedge funds and not having hedge funds. And given the fact that our hedge fund returns have not really matched our expectations up until now, and that there's like a considerable implementation risk in terms of being able to achieve those expectations, I would make the argument, but I understand that I'm probably a minority voice on this board, that it's not worth 4 basis points of median expected return to continue to invest in hedge funds. And that's not inconsistent with, the scenarios that were presented to us at NYSERS. So I would just urge my fellow trustees here to think about that, but I'm not going to seek to impose my view on the Police Pension Fund Board. You'll be happy to hear down at that end of the table.
And so just to, without repeating the whole multi-meeting discussion that we had at NYSERS, you'll notice that hedge funds is not the only one of the alternatives that has on a one-off basis, a very incremental effect. That's mean variance analysis. And what the other consultant said, and I don't want to put words in your guys' mouth, but as we went through, when you're having multiple sources of risk in a portfolio, multiple sources of return, if you can get additional sources of return that can bring you incremental risk, it's an additional shot on goal, and it is desirable, even though on an incremental basis it can seem fairly small on a mean variance basis. They have different paths. We've seen that, and to some extent, some of the concerns about hedge funds have been hedge funds doing exactly what we would expect them to do, which is to have a different path than equities. And so that's one of the reasons that you want them long term. Over short periods of time, it can be disconcerting because equities are going straight up. They're invested in equity securities, but in a fashion that travels on a different path. And so, as we'd said in the other meetings, BAM is endorses the thinking that Wilshire and others have, that having a full set of alternative exposures is the best path to pursue. And I'll give you guys a chance if you want to disagree with me.
No, ditto. Yep.
Bobby, you had something? You want to just second? I just want to address one point, and I hear your concerns about not getting the return that you've expected and risk. But the issue for me is, at the end of the day, hedge funds are an asset allocation, an asset class that has been around for some time, and I don't think that they would be a viable asset class if they consistently did not return money over long term. And I think we're getting the discussion of possibly getting out now. I'd hate to get out now and then suddenly there's a good return in that asset class. So, which has happened in the past, unfortunately. Sometimes there's a little bit of a knee-jerk reaction. And I go back to what I hear all the time, and it's listed in everybody's booklets, past returns are not indicative of future returns. It's the same thing. Just because they're not doing that well now, and I'm sure they have many reasons why they're not performing as well. Sometimes not having to do with the market itself, but regulatory and sometimes banking decisions on a federal level. That's why they're not returning getting their returns back. I'm not an expert in it, and that's why I rely on the experts to give me the recommendations. So I'm comfortable with being in the absolute class here, hedge funds, and I think the alternative that you've provided, I'm good with right now.
I'll second it.
Right. Thank you very much.
Oh, do we need a motion to close? Motion to adjourn?